26 bankers were sent to prison. While every other country handed trillions of dollars to the institutions that caused the 2008 financial crisis, one tiny island nation of 317,000 people made a different choice and became Europe's fastest-growing economy. Through the early 2000s, Iceland transformed from a quiet fishing nation into an improbable financial powerhouse. Iceland's three major banks, Kaupthing, Landsbanki, and Glitnir, expanded aggressively across Europe, offering sky-high interest rates to attract foreign deposits. By 2007, their combined assets had reached nearly 10 times Iceland's entire GDP. In October 2008, the global financial crisis hit Iceland like a tidal wave. Within a single week, all three of Iceland's major banks collapsed, one after another. The Icelandic króna lost approximately 50% of its value against the euro, and the stock market fell more than 90% from its peak. Every major Western government chose to rescue their banks with taxpayer money. Iceland faced the same pressure, but its citizens pushed back hard. In 2010, a national referendum rejected government plans to repay billions owed to British and Dutch depositors, with 93% of voters saying no. Iceland's government established a special prosecutor's office dedicated to investigating the banking collapse. What followed was unprecedented in the modern financial world. By 2016, over 26 senior bankers had been convicted and sentenced to prison terms ranging from 1 year to 5.5 years. The immediate aftermath was brutal. Iceland's economy shrank by approximately 10% between 2008 and 2010, and unemployment rose from around 1% before the crisis to nearly 9% by 2010. The government imposed strict capital controls to prevent money from fleeing the country, a step widely criticized by international economists at the time. But Iceland's recovery, when it came, was remarkable. By 2016, Iceland's GDP growth rate reached 7.2%, the highest in Europe that year. Unemployment had fallen back to around 3% by 2016. Tourism surged, the fishing industry remained strong, and the country's debt burden was far lower than nations that had chosen to bail out their banks. Iceland's story challenges one of the most powerful assumptions in modern economics, that banks are simply too big to fail and must be rescued at any cost. Iceland proved that a country can hold financial wrongdoing accountable, absorb the short-term pain, and emerge stronger. Whether the world chooses to learn from this tiny island remains to be seen.